joining us today for our event, Think Like a Challenger, How Banks and Credit Unions Can Better Compete and Win. We're joined today by our moderator, Stessa Cohen, who's an independent analyst and advisor for the global banking industry and also spent 2 decades at Gartner. We're also joined by Ted Brown, who's the co-founder and CEO for Digital Onboarding. He also headed up sales at the first company to build a platform to enable banks and credit unions to open accounts online. And Bryan Clagett, who's the Chief Revenue Officer at Moven, who formerly drove GZO's marketing as Chief Marketing Officer, and that company was sold to Jack Henry. So welcome, everyone. Before we begin, I just want to remind you that you can use the Q&A function, which is at the footer of your screen. So if you've got any questions throughout this discussion, feel free to post them and we'll address them.
Okay. Great, thanks, Lori. Again, my name is Stessa Cohen, and I'm going to be moderating this conversation today about the growth of neobanks and how credit unions and community banks can compete or beat those neobanks in this constantly changing environment. I guess the best place to start is with a brief definition of what is a neobank. Obviously, it's a new bank. You also hear them called challenger banks, de novo banks. Creating a new bank is not a new thing, but it's become more and more frequent. It seems like almost weekly you'll hear about a neobank starting somewhere in the world, maybe multiple of them in any week. In particular, what we're seeing now is the emergence of those neobanks targeting very specialized markets. Teenagers, for example. Revolut and Monzo over in Europe are targeting teenagers. Even Wells Fargo and B of A have re-upped their initiatives to target teenagers. You're seeing banks specifically targeting freelancers or gig workers, very small businesses or medium-sized small businesses. So they're very focused, many of them. They're acquiring millions of customers all the time, every month. And the question is, it looks like they're competing or even disrupting the market, but are they really? And I think that's a great place to start with our first question. And I'm going to start it with Bryan. How much of a threat are these neobanks?
Well, I mean, I think they're certainly a legitimate threat. I'd probably start by saying I've read your articles on segmentation, and I know we share some views on the teen market as a whole, but the bottom line is they are having an impact. I mean, what we're already seeing is this deposit displacement that's occurring in the market. But I like to look at the numbers. You know, Ron Shevlin, I know you and Ron are tight. You know, a year ago, he put out a survey that showed that about 4% of millennials viewed a digital bank as their primary financial institution. Fast forward that to December of 2020, that number jumped to 15%. So 15% of millennials now consider a neobank or a challenger bank as their primary financial institution. And we could probably slice that up a little more to get it a little accurate, but I think that's an astounding change that's happened pretty currently. The other thing I like to look at are kind of like the monetary statistics around it. Neobanking as a whole, from a global perspective today, is valued at about $35 billion. And that was at the end of 2020. That's remarkable because 10 years ago it was valued at zero. At this point, it's expected to expand at an annual compound growth rate of about 45 to 47%, if I remember. So that is substantial. So imagine what this is going to look like in 2025 or 2028. You know, the neobanks, I believe, are benefiting from customers' frustration with their primary banks, often stemming from the onboarding process, uncompetitive pricing, unexpected fees, overdraft, and honestly, you know, not so consumer friendly positions in particularly the digital world. Community banking today, or banking or credit union, if you want to call it, is fraught with friction. And the challengers out there realizing that banking is a commodity, it's fundamental utility. We need to find a way to make it easier. Ted, any thoughts on that?
Yeah, I think it's a clear threat. They've clearly, by the numbers, uncovered a need in the market or a desire in the market, an unsatisfied need. I think the challengers have great opportunities, but if the incumbents don't react to it, my money's on the challengers on seizing that opportunity. But That said, I do think the incumbents, and I include all of the community banks and credit unions in the country, as well as the mega banks in that characterization, as holding all the aces in their hands still, if they can react to what the challengers have clearly uncovered in terms of underserved needs within the market. The challenger banks are going to need to turn into banks if they're going to be profitable. A lot of them are, not banks or fintechs. They're not full service organizations. They can't serve a household with all of their financial needs necessarily. But they're definitely very talented teams that are progressing in that direction of being able to serve these niches and their full household needs or full individual needs. And if the incumbents don't react to that in time, they'll probably seize that opportunity. But right now, I think that they've really just uncovered the opportunity, and it's really on the incumbents to react to that and prevent them from taking away their relationships, really.
Yeah, I mean, I want to just challenge you a little bit on kind of the neobanks or challenger banks taking all of the customers. I mean, what we know from survey after survey for years, I mean, anyone who does a survey, is that people acquire new bank accounts all the time. So it's not unusual for people to just adopt either a new channel, a new device, or a new bank because, oh, that looks cool, and I want to try it and see if it works for me. Certainly a lot of people did that with PFM tools and, abandoned them. That's not the same thing. But do we really see, 15% of people making or younger people making a challenger bank their primary bank? That still leaves 85% of people not moving to challenger banks. So I think that are credit unions and community banks risking being too complacent by taking that position that, well, that leaves 85% of customers for us? Is it too risky?
Yeah,
I think it is. Yeah, it is too risky. And the definition of PFI is changing. What is a primary financial institution? To someone like me, I don't have an answer for that. I've got relationships at traditional banks where I park money and I use them as a utility to pay my bills, in essence. And then I've got what I would call my real money or wealth at like a Raymond James. But I also have relationships with Betterment and with Capital One, because I'm price shopping for parked cash. Ted, I think I interrupted you, by the way, so go ahead, add your 2 cents.
No, I think Stessa was saying about the same thing. So a lot of the neobanks around the checking product, right, today.
Yeah.
When we talk about neobanks, we're usually talking about a checking product. There are, of course, other ones as well. But the point I was trying to make is that they really need to innovate beyond the checking product. They've uncovered a need within the market and clearly shown success from an account opening perspective, getting people to open those accounts. But their challenge is to then land and expand. So they've got a wedge in the door, and can they become full service banks in time or are the incumbents going to react quickly enough to be able to build that holistic, profitable relationship with an individual or a household?
Yeah. Well, that's a good point that you bring up in terms of account opening. I mean, we see a lot of great numbers, number of customers opening accounts with this Chime or whoever, But what happens next, and that's not particular to challenger banks, is that you have to get the customer using the account. If it stays dormant or they just park $20 there, like I did with a credit union here, they're not too happy.
That's expensive too. That's costing them money.
So what are they doing around turning around these accounts to make them engaged in profitable relationships? And are they, do you think, Ted?
Yeah, I think that a lot of them are doing a good job or a better job on the margins of getting account holders to, for example, use the debit card as their primary payment method, through their branding and the other things that they do. So I think they've seen good success in those conversions and generating interchange revenue at a higher clip than potentially some of more traditional checking accounts. So I do think that they've done a good job on the margins around the experience, but to the larger point of can they build that into a holistic, profitable relationship where you're serving that household for multiple needs. We know by the numbers that's where the ticket is. That's the golden goose of capturing the relationship. The checking account is really just an opportunity to lose money or earn money. When you've gotten an account open, you've not made any money yet. Even if you've gotten the initial $20 deposit or $100 deposit, you've really just opened up an opportunity to either earn money or lose money. If the customer doesn't go on to ultimately use the product and then turn to the institution for their next financial need, like when they buy a house, or maybe with some of the niches served by a van, who are they going to turn to help them buy that tricked out van or that house? If they're not able to turn to the institution that serves their checking needs, they're going to turn to somebody else, and that's where a lot of the profit lies within the banking relationship.
Do you think like a niche like teenagers, and this is like kind of like a thing I have.
It's a trap question. She's going to try and trap you with this.
No, this is for both of you. Do we really think that's a niche that wants to engage, like people that want to engage with banking and have a relationship? I mean, and I ask this seriously. I mean, I wonder, is that something that is for, I'm going to spin it out, geriatric millennials, because I love that term. People that are around 40 that have different, or older that have different financial needs. And maybe, we're looking at this like, capturing all these new accounts for these, niche markets, niche banks. Is it really a differentiator?
Yeah, I mean, I think part of the issue is labeling is a problem, right? And I know this is again a topic big with the analysts, and I like the topic because I believe banks and credit unions are too mesmerized with millennials, for one thing. All financial institutions should have some form of a strategy to reach a younger demographic. Let's call it that without giving it a Gen Z or a millennial label. I believe there's a millennial in all users right now. And it goes back to, what really is driving transformation in the industry right now. And Sapient did a study on it over the last several months. And the number one thing that's driving digitalization, it's not demographics. It's one, the COVID pandemic. Number two, customer inquiry and customer need. Number three are digital first challengers and or fintechs, which means banks and credit unions are playing follow the leader, which they're really good at doing. And yes, that is a bit of a criticism. And then, direct competitors is at 33%. And then at 28% is big tech, Google, Apple, and the like. So, I don't believe that micro niches are really, or hyper niches are really ideal for the average financial institution. I do think they're good for some markets. I'm working with a company right now that focuses on active lifestyles, outdoors, outdoor fitness, that kind of thing. I don't want to give the name of the company out because I don't want my competition to hear about it, but they've got an e-commerce site, and they want to create a challenger bank because of the potential that exists with interchange income. And they get to create an affinity credit card around it too. So they're going to use banking as a means to help create more of a community and or leverage their community. They're offering cash rebates on outdoor related and fitness related products. And they're sending physical checks. They want to move to a digital, platform to reduce their cost while generating conceivably, income. So generally people migrate toward, let's focus on the younger segment, call them millennials, and focus on selling product to them. The problem is there's a younger generation following the millennials, and then there's a younger generation following them. Years ago, there was an interest in the boomers. When I got into banking in the 80s, everything was about the boomers have all the money. We have to focus on them. Well, you know what the boomers used to be? A lot of the boomers used to be hippies in the 70s and the 60s, right? And you know what you call them today? Republicans. People change through time. And to just, create a stigma that says, hey, we're only going to focus on millennials, and look at the way banks and credit unions advertise millennials. It's a bunch of people with man buns playing hacky sack on a beach. I mean, the stock photography alone is a negative. It's lazy marketing. To me, they ought to be moving toward a personalized offer that's more one-on-one, that's focused on individual needs rather than categorical needs.
Well, that, and your example of the lifestyle thing is what I call a hidden tribe, right? It's not something I came up with, but I've applied it to banking, and that's looking for commonalities regardless of household income or age, or where you live or whatever, and looking for these things, because I think that's a really rich area to mine for that long-term relationship. Like, there's a reason to onboard me and to engage me because I have the same interests as you. There's a small credit union out in Colorado that focuses on solar and environmentally sustainability, inside the credit union and externally. And that's a draw across all these demographics. Right. It's not just the green people, but somebody who wants to buy a Tesla or build an LED building. So I think that's a rich area for credit unions and community banks to compete. How much time do you guys see credit unions and banks having to figure out how to compete, and are they going to focus on niche, or what are they going to do? How long do you think the lead time here is?
I'll let Ted start that one off.
I'm not going to give you exact number of years, but I'll give you, in my opinion, they have until those neobank challengers build out a fuller suite and a fuller land and expand strategy. That's in my view, the time that incumbents have. Because at the end of the day, the incumbents, again, in my view, still hold the aces. They have the relationships. And at the end of the day, it's really hard and really expensive to acquire a new banking relationship. There's just no getting a profitable banking relationship. So we know a few things about the neobanks, and again, mostly around a checking product. We know that there is an opportunity to open up accounts. That's very clear. We don't yet know if that opportunity can lead to great profitable businesses. We know that there's been a number of neobanks, some of the earlier ones like Simple, who did a really great job in terms of opening accounts and highlighting that interest within the market. But of course, PNC shut down Simple recently after the acquisition from BBVA Compass because it wasn't profitable. So that's my answer is when the neobank challengers can figure out how to turn those opportunities they're creating into true profitable relationships, meaning you get them in the door with this experience, this message, this niche, this whatever unique segment they're serving, and are able to really effectively onboard that user so that they're actively engaging with that product, and then also have those additional suites of products so that they can expand the holistic relationship, serve the other financial needs on the lending side and the other areas. So when the neobanks turn into banks is when that's the timing. But from an incumbent standpoint, and that's assuming the incumbents just don't do anything. Obviously, there's time to react and change the way that we engage with our pre-existing relationships, because you think many community banks and credit unions have established those existing customer base in totally different tactics. They were relationship based with employers, or most of them were based off face-to-face interactions, people visiting a branch, people having coffee with a banker or a person, and those are happening fewer and fewer. And there's not been this sort of digital engagement aspect to those traditional businesses. But you still have that solid existing base of relationships. And if we as incumbents can continue to nurture those relationships and get the next financial need, we know that if you serve a household with 3 products or more financial products, they're 10 times less likely to switch to a competing institution. So that makes it 10 times more valuable, 10 times more expensive for the challenger with a massive marketing budget to take it away.
Right. And that's been a key challenge, I know, for credit unions in particular, losing that familial link. Like kids would just bank where their parents did, and that's what you did because, I mean, you walked or rode to the bank branch. It wasn't like there were digital choices, and that's really gone away. So going from, what you're talking about to looking at something more, what they can do to be more proactive, what role do you see for customer and member journeys playing in terms of how do those play into the engagement, the digital engagement? I mean, not only has branch visiting gone down, but I think the pandemic really drove a stake through the heart of being able to rely on that at all, right? I mean, it wasn't a choice, branches closed, right?
That's right. So, the old traditional model that worked well was sort of face-to-face sales. Wait for someone to come into a branch, engage with them that way. We clearly accelerated by branch closures with the pandemic. That is not an effective sales tactic or strategy anymore.
Yeah.
You can't wait for people to come to you. By the numbers, 1 in 3 existing customers will turn to a competing institution for the next product if you don't get in front of them and engage and make sure you're in the running for that next product. So we can't sit back and wait for people to visit branches to engage with them anymore. So obviously, a digital engagement strategy, a digital engagement platform, technique, some way to engage digitally is absolutely required. If you want to continue to be able to nurture those relationships, we can't sit back and wait for them to visit the branch anymore.
And banks and credit unions can take baby steps, right? I read another Cornerstone report, and it showed that only 19% of financial institutions, or actually 13% of financial institutions had a digital transformation strategy prior to 2020, which is amazing. But now, because of COVID, they're all saying, and maybe it's just to pacify shareholders, that they're all going to be investing in digital transformation. What is digital transformation? No one's really defined that for me holistically. And they're stymied by the thought, I think, right? They may view transformation as something as robust as what Alliant Credit Union is doing, which is closing all their branches. That's an extreme, right? They're going digital only. And it works for them because they're, their primary sponsors, Continental Airlines or the old Continental Airlines and United. But there are baby steps they can do. For example, onboarding, right? Specifically, if you don't have an ability to onboard in a digital fashion, you're throwing away money. You can't rely on the wait and come and hope model of the branch model.
Right.
And this is not going to be the last pandemic. Things are going to change, but behavior is changing, and it goes back to the younger audiences today that are growing up in this digital first market. They don't want to be troubled with having to go to a branch to open an account. So it's got to be, their journeys have to begin the second they enroll in an app, the second they open an account.
And even going even further, the whole demarcation between online account openers and branch account openers. I mean, I think the thing that gets missed in what is digital transformation is it should be transforming both and obliterating that boundary. Well, this is a branch customer, so we service them this way, and this is a digital customer and they get serviced that way, or they get these offers or this journey. I mean, just watching my own Gen Zers, they don't think of themselves as digital banking at all. They just look at their phones,
Yeah.
I mean, they don't think of it as digital. I think the thing where transformation is going is that it needs to be everywhere. And so much gets lost around digital and branch. And I'm not talking about sticking an iPad up instead of a teller. But I'm thinking about how do you make that everything more engaging, right?
Well, and you know, that's a good point. Whether you're truly going through the process of digital transformation, or if you're simply trying to become a more consumer-centric brand, which ultimately, or more relevant brand, is ultimately what it's all about. It goes back to the discussion that we've had for literally decades, since you and I were at Course Dates, Stessa, in the 80s. The subject of data, it's the four-letter word that everyone's afraid of, you know? With digital and with digital channels, or even with full-fledged digital transformation, there's an awful lot of data that can be used. And the data is not just data from the core. We know the legacies are pretty hard at providing some of that data, but now you've got the ability to look at analytical as transactional data as well as behavioral data. And the goal of any financial institution should be to take that data and turn it into contextual engagement so that your relevance is clear. My bank is constantly reminding me, this is a $25 billion bank. They're constantly reminding me I should save for retirement. I've already retired once. All right, I'm past retirement. They've also come to me and suggested I save for my kids' 529s. My kids have accounts at these institutions. They have their payroll, or at least my daughter has her payroll going into that institution. She's past college. So their engagement with me is completely irrelevant. And frankly, I just tune out any message I get from them. They're no longer relevant. Simply a place I park some money. And when a better opportunity comes along with price, that money's going to ship right out. So it doesn't matter where you are with your so-called transformation plan or schedule or strategy. Start looking at the little stuff, the data that's right in front of you, and turn it into information that your customers can use.
Yeah, digital transformation is a beast of a project. It's a beast of a term.
Right.
And yeah, a lot of it is infrastructure, behind the scenes infrastructure. But there are a lot of really low hanging fruits that ought not be put aside or put off until that infrastructure has transformed. And not surprisingly, we think it's the onboarding experience and process. When you just look at the numbers and you look at the low-hanging fruits, I just want to define what I mean by onboarding, but for just a moment, because when I say it, it's probably not what most people think. Most people in our industry think about the account opening process, being able to open an account online versus in the branch or with a piece of paper. It's really not what I'm talking about when I talk about onboarding. I'm talking about the experience after an account's opened. The account's a transaction. It's going to happen. You do the KYC. You approve someone to open up an account and do business with you. Onboarding is, in my view, my estimation, everything that comes after that. I make a comparison when you join a company, your onboarding process isn't signing the offer letter. That's the transaction. The onboarding process is everything that company does to make you productive at the organization, comfortable with the organization, understand the organization. And that's where there's massive low-hanging fruits for financial institutions to improve that post-account opening experience that leads to sticky relationships and profitable relationships.
Could you elaborate a little bit more on how credit unions and community banks in particular can use this to compete with the challenger banks?
Absolutely. So when you just look at the numbers, industry-wide, 20 to 40% of checking accounts are closed within the first year that they're opened. So clearly, we focused a lot on that transaction of opening the account, and that can balloon for certain segments. So if it's that's a blended rate, for example, that includes people who walked into a branch, had a cup of coffee with someone. It also includes people who took 5 minutes out of their day to click through an application online. When you just isolate that, the digital account openers, and particularly add another filter where it's people out of network, meaning there's no branch close to that household. We've talked to financial institutions where the first year attrition rate is north of 90%.
Wow.
So just think about that for a moment. I'm sure it's not that high in other areas or the neobank challengers, but it's going to be pretty high. The consumer behavior is not that different. So by focusing on, that's where looking at those numbers and picking that is a super low hanging fruit. If we address that and find a way to address that before the rest of our digital transformation infrastructure is, in progress, That's going to be a huge advantage in terms of actually converting the accounts that get opened into true profitable banking relationships that
So
you can
how
build
can,
on over time.
okay, so sorry. So how can we use data in the onboarding to actually make it more engaging? Because I'm thinking particularly like there are specialized police and fire employee credit unions in Philadelphia, and this is just a Philadelphia example. I know I've seen maybe one branch, right? But there are firehouses of police officers all over the city. So if I open an account there, where's the branch? In fact, my neighbor who is a cop asked me, where's the, I'm like, I don't know. Just because I work in banking doesn't mean I know where all the branches are. But, you know, how can they, if he opens an account, how can they make him sticky, you know, right away so that if he needs to, he can search out the branch, but he can otherwise start doing what he wants to do with his money and finances through that credit union?
Yeah, data is key, and there are what I'll call them shortcuts to use data before you're completed with your digital transformation project. Because again, a lot of the infrastructure and the digital transformation is behind the scenes. But I'll give you a quick example. You know, if that person, you know, say opens up an account, or we can know where they're physically located.
Mm-hmm.
And right when they open up their account, we show them exactly where the closest ATM is, or the exactly where the closest shared branch might be, or shared ATM that's not branded for that credit union.
Oh, I love that.
So that's a piece of data that's not reliant on, you know, anything from the bank's infrastructure. It's just tagged on where they were located when they open up the account, or where they're located when they open up an email, and we can tailor that experience in a way that's going to maximize the utility of the product that was just opened. And now you've got a relationship. Now you've got someone using the ATM. Now you've got someone actually using that product that they took time to open. So that's just one small example of a shortcut, if you will, of a little piece of data that can improve that experience, give an advantage to utilization. And again, ultimately, the advantage that a lot of the incumbents would have is that full ability to create a full profitable relationship. Another example of, you know, data that doesn't necessarily rely on, you know, infrastructure change, appending your member data or customer data with those that are in market for a mortgage. You can find that out, and you can do a tailored outreach to say, hey, I know you haven't asked your credit union for this product you're shopping for yet, but you know you can get that from your credit union, qualified, here's your rate, you know, here, go through the process.
Right.
Another example where data can be, you know, take advantage of that be a huge, you know, competitive advantage of mining those existing relationships for additional ways to serve the household, because that is the comparative advantage, is the existing set of relationships that an incumbent has.
And I know a lot of credit unions struggle because people will open up memberships to get a good car loan rate, but then they never see that customer until they need a new car.
Well, indirect is a good example at it. Indirect lending, right? It was thought to be as a market acquisition tool. And ultimately, I can't tell you how many financial institutions I've talked to that have seen, you know, it's only the loan they get and the relationship's forgotten. Right. So if there's an onboarding opportunity to sell your value proposition and leverage data, it sure as hell is in indirect, but it's been kind of a failed market acquisition strategy. They get the loan, they sell the car, they're done. The relationship's gone.
So what we're saying is that there are things that you can do to transform the bank, the financial institution, without going through some big, huge strategy, analysis, paralysis, and angst. Even so, and on that thread, I think there are some existing commoditized capabilities that banks and credit unions offer that can be unleashed in new ways to disrupt or challenge the challenger banks. And I know we're primarily been talking about consumers and banking, and there's a question out there about business banking, which we'll get to. But can we talk a little bit about that? And that goes to what you brought up in terms of data, and transformation. how can these commoditized products and services be disruptive?
How can they be disruptive? I mean, first
Yeah.
of all, I think the issue is how can I don't know if it's necessarily the product or the thinking behind the financial institution. I think bankers need to stop thinking themselves as simply bankers, because when I think of a banker, I think in terms of two things, the transactions or the loans. I think they need to view themselves more as enablers. I think to be transformational, you need to view yourself as an enabler. A neobank is an enabler in the sense that they're enabling you to get access to financial services easier. That's a big part of their value proposition. The financial institutions out there that I know today have this awesome opportunity, probably the best opportunity they ever have had, and that is this high-tech, high-touch environment that they have, right? But it still doesn't answer the challenge of product, right? A CD is a CD, a checking account's a checking account. You can go out there and you can create a really robust checking account. You could bring in rewards from a Strategy Core or a Kasasa or anybody like that to add a different flavor, to diversify your product offering. You can change your policies, be it overdraft to be a little more open and engaging. You could look at bill pay differently. Bill pay is a forgotten product within the banking mix. There's companies
and it costs the banks. It costs.
Yeah, it costs the banks. Think of the data in bill pay alone that can be leveraged. There are companies out there like Blip that turn that data into actionable insights. You can do something with it. You actually can monetize it. People have to pay their bills. That is a daily occurrence for most of us, right? It's fundamental to quote unquote banking. The fintechs that are out there, the neobanks that are out there, the bigger mega banks, Lisa brought up the subject in the chat window, aren't the mega banks really a big threat? And you know what? Damn straight they are. But they're figuring this out probably faster than some of the neobanks are. And by the way, it's going to be the mega banks that buy a lot of the challenger banks. I put money on it, literally. But there's an opportunity today to rethink the daily financial lives of the people we're working with as bankers, be it financial wellness and defining what the hell that means. Not financial literacy. Don't call somebody illiterate by suggesting they need financial literacy, but give them insights into their spending and their savings and how they could put their money to use. Show them scenarios as to how their peer group is spending their money and how they compare to them. I'm not saying it's like one of these we're better than the Joneses type of mindset, but people need to know how do they compare, especially geographically. Financial services is not truly about banking. It's about how we interact with money and how we survive in an economy at the end of the day. Banks have to kind of step back and say, well, what is really banking and what is financial services? And they aren't doing it. They're focused on the transactional side. And they also hide behind legacy technology. They love to bitch and moan about their technology not being where it needs to be. Well, you know what? You don't have to rely solely on a Jack-in or your Fiserv. There are a lot of other people out there you can go to, and a lot of these cores are beginning to work with people, like us and Ted, and the cores are trying to reinvent themselves. There's no doubt about it. They're more at risk than the banks probably.
And I think Lisa, in her question, talking about mega banks being able to partner with fintechs that have specialties that enable them to become a bigger threat. Those partnerships are not limited to mega banks. So yeah, those are very big challenges in addition to the challenger banks. But credit unions, smaller banks, mid-sized banks, community banks can also take advantage of these fintech partnerships, because more and more you see fintechs specializing in the credit union, small bank, community bank spaces, which I think maybe it's a bias I have, but in some ways they're better positioned to deal with the data that we've been talking about, because they don't have 400 CRM systems that have never talked to each other, and they don't have payment systems that no one has ever extracted data from, because that just transmitted payments to the Fed or Swift or whatever. We never had to, if I can tell you the number of times I heard, we never had to get data from that system out. I could buy one of these places, but so I think there's an opportunity here that if you push away all the hype around digital transformation strategy and challenger banks, that the niche spot is actually for the banks and credit unions that fit in the middle, if you will.
Yeah. Have you heard of the new incumbent or the new challenger bank that's focusing on immigrants? It's called Cheese. And it's going to specifically be rolled out and targeting, Asian-owned businesses. And this will get into some of David's comments in the chat window about SMEs and whether banks or not are still positioned well to serve the small business market. I think the answer there is they are for now, but they won't for long unless they bring more of a digital first kind of value prop to the table.
Yeah. And these communities that may have high rates of small businesses, and not only small businesses, but small businesses that interact internationally is really key. Another area, and I've written a little bit about this in terms of branches and in-person services, is underserved communities, like the Black communities, Black women, these areas where there are people devastated by the pandemic and may be looking for a new job and looking for credit. They may not fit the typical credit risk models, that if challenger or incumbent banks can come in with those services, they have customers that they can work with and may want actually that in-person service because you're in the community. And again, credit unions and community banks are right there. I mean, it's I personally see a community bank in my neighborhood working with local coffee shops, keeping them in the business, other local businesses that are small and not chains that people in this neighborhood want to keep in business. So I think that opportunity, if you look beyond so taking what Lisa was talking about, specialty like credit risk analysis, boring topic, for small business, if you can work with a partner that allows you to do alternative risk analysis, but still risk analysis to make those, loans and investments in the community, I think it's going to make a difference. Not just a dent, but it's going to change people's lives, which is, again, what you talked to, not banking. So I let Ted get in word in edgewise.
Yeah, on this topic of partnering with fintechs, as well as innovating around, I think you put it, commodities or old things. I like any innovation, any strategy that is building that relationship, that continue to nurture and build onto that relationship. So you look at partnering with fintechs, for example. A lot of these product-specific fintechs that have seen great success, they're proving markets. But at the end of the day, there's if we're students of history, we can see countless fintechs who pivoted from B2C strategies to B2B2C strategies. Gzio would be one of them. Yodely would be another one. We constantly, it's just relearning the hard truth that is very expensive to acquire a new customer relationship directly B2C.
Yep.
Yeah.
And the advantage of building on relationships is huge if you can do it. B2B2C makes so much more sense to B2C from a strategy standpoint, but it often falls down in execution because this is not yet part of the core competency of many traditional banks and credit unions. Building, partnering with that fintech and bringing that clear, what others have proven as a clear consumer desire or demand, packaging that together, bringing it to their existing customer base or membership base is not yet a core competency, but it needs to become a core competency. We work with a lot of traditional banks, credit unions. The last new product they launched was a checking account 30 years ago, right? So it's about building that as a core competency, building that as something that you're really good at, and I like any innovations around it. So one example of an innovation that's really not new, I kind of like the example of Hotels Tonight, which might have been a total 2019 example since no one travels in 2020 and stays in hotels. But what they did with their app, if you're familiar, they did a great job of both user experience, visualization, and giving you a reason to open that app to book the next hotel. And anything around that gives your existing customer, existing member, a good reason to check in with you and get the next service from your institution, is where, in my view, people need to be. Those where the innovations need to happen on the margins, because at the end of the day, that's who wins this market, is those who can best kind of land and expand and grow those relationships to true profitable banking relationships.
So I wanted to pull a couple of threads out of what you were saying in terms of products and what Bryan mentioned in terms of the cores, and pose this question. Are the core providers able to weaponize bankers?
I think they are able to. I think the question is whether they're moving quick enough. I think that's a big component of it. If I look at the acquisitions most of the cores are making, they're very strategic. The challenge to them is, how do you leverage that talent in that product that you bought without, in essence, diluting it with some of your legacy offers and or thinking. That's a big challenge. But companies have that same challenge. We already mentioned, Citibank is a good example. Citibank is a massive worldwide global player. But if you talk to anyone in the technology groups there, they've got 3 core systems. They got the retail, the institutional side, and wealth, and they don't talk to each other. So, I think the cores understand that they have a lot of data and they hold a lot of authority, we'll call it, from kind of a relationship point of view. If they can figure out how to open up their architecture while still monetizing it, while helping the banks survive and or grow, yeah, they can do it. I don't know if I'd call it really a weapon though, right? Today, their approach may be more shotgun than sniper. I think they have to roll up their sleeves and kind of specifically get in there and say, how do I help you grow? How do I help you survive? And it's not going to be built on quote unquote a core platform. Your core technology is not your disruption strategy. It is not truly your digital strategy. It's part of it, and you want it to work with other providers. And fortunately, because of open banking, embedded finance, and BaaS, these things are happening slowly but surely. But I want to get back to a question that David asked, because it's kind of interesting. David Newman asked this question. So he made the statement that maybe community banks still have a good strong hold of the lending space of business relationships. Generally speaking, yeah, especially on the treasury management side, bigger enterprise level, certainly. But if I look at the successful fintech challengers out there today, as well as kind of the soft underbelly, or i.e. the markets that banks are ignoring today, it would be freelancers, gig economy workers, and small business, right? And that, I think, those are the prominent niches that the challenger banks are going to focus on in the very near future. And I think that will be highly disruptive conceptually to banks' bottom lines.
And I think you're right, because open banking, embedded finance, all these capabilities, you see players like Fundbox, nestling into your cloud-based accounting solution and going to a bank for a loan. Heck, they can tell you when you need the loan.
Yep.
And if a bank is smart partnering with that, avoid the loan. I mean, that's the opportunity. That would be the disruption of the disruptor. Avoid the loan. I can help you manage your business, not so that you don't need that loan.
Yep.
Did you know you have this yearly cash flow like this? It might be very small, and we can avoid it by doing X, Y, and Z. I didn't know the bank could do that for me.
Yep. Yeah, no, there's just a lot of opportunity. So we probably should start wrapping this up, because I know we're running low on time. I'm going to just add a couple of comments, then I'll let Ted add to it. I think that if you really want to challenge the challengers, right, which is really part of the theme of this, or challenge the niche bankers out there, you need to challenge yourself. You need to challenge your thinking. You need to redefine what is banking, and you're going to get that answer from your customers. If your customers think you're simply if you think your customer is simply a commodity to you, and you're not looking at it from a relationship perspective, you're really missing the boat. And everything Ted is talking about is, how do I build a relationship from these new entry points, or these new experiences, or these new account openings, or these new enrollments in a credit union as a member. You got to leverage that. You've got the data, You just got to turn it into actionable information that you can do something with. And in the digital first world, they're figuring this out. Their thinking is not siloed. They're not looking at the constraints of an existing platform. They're looking at this from a fresh experience. And in essence, they're starting to decommoditize the industry. But if you don't understand the needs of your customer and you don't leverage that data and turn it into information, I don't care what your transformational strategy is, it's not going to be worth a hill of beans. Ted, thoughts?
Yeah, absolutely. Just to address a couple of the comments in the Q&A within that sort of summarization, couldn't agree more in terms of the opportunities within small business. We've been focused a lot of the conversation around the retail relationship, consumer banking, a lot because that's the more popular neobanks that we hear about. But everything we've talked about so far is probably multiplied by 10 in terms of the opportunity to increase engagement in the way that we interact with small business owners to capture the additional needs and opportunities that they have, and that a bank can serve them with, because they have more needs than a consumer household that could be addressed, and there are great opportunities for both retention and fee opportunities. And to address kind of Neil's question in terms of where does someone start? This digital transformation, as we were talking about, could mean one of so many things. Could be from the core, could be from the infrastructure, could be so many different areas. Where does one look to start? We look for those low-hanging fruits. So where are there opportunities to have a big impact to the business, big impact to the P&L? That's why we end up focusing on the engagement or the onboarding process, as opposed to all the other things that we could focus on. We look at the numbers, we see that as a huge low-hanging fruit, converting the time, effort, and money that goes into acquiring a new account, turning that into an engaged relationship that can continually build on that relationship, because that's where we think the low-hanging fruit is when you look at the numbers, and where an incumbent who has this really big advantage of established relationships really ought to be starting from that digital transformation or strategy process is, again, anything that leads towards increasing that relationship or that share of wallet.
Yeah. And I know Neil asked the question. I'll just jump on what Neil's question was. He literally said, where does a bank or credit union even start when there's so many options out there? I would say start with this. Strategically, what is the experience you're trying to build? Okay. And don't say a banking experience. That's not going to work, but define it. What is the experience you're trying to build? And then I would say part B to that question is, how is it different? And then go build it. And you're going to build it using high tech, high touch. In today's world, you can leverage your branch infrastructure, you can leverage your operational infrastructure to build an experience. And often the experience that's impacted where the rubber hits the road, which is the member or customer experience, is impacted by the back office. The digitalization or lack thereof in the back office has a huge impact on the experiences delivered.
And kind of in summary, I think one of the takeaways here is that if someone is selling you or telling you, here's the template for digital transformation and, acquiring all these millions of customers or members or increasing profitability, the same way that it doesn't work for your customers, it's not going to work for all banks. And so while it sounds wishy-washy, it's actually not. It's identifying your strengths and weaknesses and going after what makes sense to you. I once spoke to a credit union client that was like, well, we have great relationships at the branch, so what should we do digitally? And I was like, well, use technology, leverage technology to bring that experience to digital. Why forget about it? Why forget about it? It works, but use the technology not to just keep up and say, oh, we have this fancy slick app that looks just like whatever the hot bank is or fintech or startup is, but use something that's going to push your differentiation out to not only your customers, but your prospective customers. Not technology, not just to be the flavor of the month, but to acquire and keep customers and grow profitability for the future. not only for you, the financial institution, but for your customers, because if you're making them money, they're going to be happier, whether it's checking accounts or small business banking or, other business banking. So I think that if we have any other questions, we have a minute or two for that, but I think that really wraps it up for today.
Yes, Stessa, thanks for moderating, and
Oh.
thanks to Ted and Lori and the team there for all they've done to kind of set this up and make it happen. We're going to make this video and recording available, and we'll ship it out to all you can share within your organizations, and you can reach any of us if you'd like more information. Last words, Ted?
I'm good.
I'm good.
Get back to your day. Thanks, everyone.
Thank you, everybody.
Everyone, for attending. We really appreciate it.